My name is Marcy Berger, and I'm the Member Services Coordinator here at AFSA. Welcome to Early Intervention in Challenging Times, presented by John Fisher and Ann Woods. This presentation is a part of AFSA's Business Partner Webinar Series, which allows industry experts to share timely educational topics directly with AFSA members. The webinars are designed to provide information that will allow AFSA members to more effectively design, develop, and implement strategies for their company's success. For more information about how to become a presenter, feel free to reach out to me following today's webinar. A few housekeeping notes. To ask a question, use the question box on the side of your screen. I'll read them aloud to all following the presentation. The slides and recording of today's webinar will be available later today on AFSA's website in the Webinar Resource Center. Finally, you'll receive a survey after the webinar is over. Please take a moment to complete it. Your responses help us fine-tune the program so we can target the issues that are important to you. A bit about our presenters. John Fisher is the Chief Relationship Officer for Money Management International. MMI is the largest U.S. nonprofit credit counseling agency. John is responsible for MMI's National Creditor and Associations Relationships and Government Relations. Prior to MMI, John spent nearly 10 years with the Take Charge America, another large national credit counseling agency, moving from a volunteer board member role to start their business development department and eventually serving as CEO and president. While he expanded national relationships and diversified services, including expansion into the housing counseling area, where TCA quickly became a nationally active organization. Prior to joining the credit counseling sector, John spent 20 years as an executive in capital funding and leasing. John earned his undergraduate degree at the University of Illinois and his MBA in Marketing and Finance from the University of Chicago. Another presenter, Ann Woods, is Vice President of Industry Relations for Money Management International. Ms. Woods is responsible for creating and managing external relationships between MMI and organizations that want to increase awareness of MMI service to their customers, employees. Ms. Woods first entered the credit counseling industry as a board member of Consumer Credit Counseling Services Southwest in 1993. In 1998, she joined CCCS Southwest, which merged with MMI in 2001. Prior to that, she was the Western Regional Director for Equifax, Inc. Throughout her career, Ms. Woods has managed a variety of business development efforts, including strategic planning, sales management, and strategy implementation. And with that, I'll pass it over to you, John and Ann.
Great. Thank you, Marcy. Can you hear me okay?
Yep, perfect.
Perfect. Okay, thank you. And welcome, everyone. We very much appreciate you joining us today for this webinar. And we hope that everybody is safe and healthy and stays that way in these challenging and very unusual times. As Marcy mentioned, both Ann and I have about 20 years experience or more than that in the credit counseling sector. We both came from commercial backgrounds, mine in leasing and lending, as was noted, and Ann with Equifax in the credit score and other data side. So some of the points we'll make today are based on coming from that experience, but clearly we know that we have expertise in the auto lending side in our attendees, and we really welcome your input on that, your questions, and even your challenges if you think something we're saying is different than what you believe it to be, because we know we have more to learn always from experts like you. So thank you so much. Let me go to slide 2 here, if I can. Hey, Marcy, would you advance that for me, please? Thank you so much. As Marcy mentioned, MMI is the largest national nonprofit credit counseling, financial counseling organization. We're 60 years old. We support clients in all 50 states. And you can see from that map there that although most clients today like to connect with us over the phone or through the internet, we still have offices in most of the major population states for convenience to clients who care to come in, which is a small percentage, and for some engagement in the local community. And you can see we also have some large contact centers that are noted there in the little orange dots in the map. Now, MMI as a nonprofit tries to approach every interaction with the consumer with a great deal of empathy to understand what's going on and to help them find a solution. And that's really critical to build a trusted relationship with them so we can make progress and help them. But as a large national nonprofit organization, we also operate like a business, like you would want a business partner to operate. And so we've seen, we think, significant performance out of that. And that's why we mentioned that we've returned over $9 billion to lenders from their borrowers in a responsible way that worked well for both. During the height of the housing crisis in the Great Recession, governments and lenders turned to us, and we conducted over 1 million counseling sessions during a short period of a few years to help people find a path. One of the things that we're going to talk about a lot today is that we do counseling for all of the consumer's debts. Now, we've mentioned 4 of the big ones there that you can see in the bottom of the screen: auto, credit card, home, and student loans. Clearly, people have others, like medical is a big one for some consumers, and other things that we might come across. But those are 4 of the big ones that we deal with regularly, and we'll speak to that today and how we think we can be additive to the work that you do. Great. So we talked about our operating like a business when you're in our management and outlook level, as opposed to our counselors that really are focused on helping that consumer. And we're sharing here some of the partners that have worked with us, a number of them for well over a decade, that direct their clients to us for counseling assistance and solutions that they support. And in some cases, they're also funding work that we do that supports their client base and their community. And one of the reasons they do that is because of the capabilities that I talked about, that they know how we're going to help folks and help them quickly. But also it's the experience that they hear about from their clients. And we sort of reflect that down below, where we talk about our Trustpilot rating that is just a hair below 5, our Facebook rating, our Indeed rating from our employees, and of course our Better Business Bureau rating. So we're proud of those, and we think and hope that those are things that you will find confidence in if and when you're looking for someone to partner with for this kind of assistance. What we want you to come away from this gathering today with are 4 primary things. 1, how is this relevant to you in a very dynamic time and to the loan portfolios that a number of you are looking to manage through this tough time? How does that work? I mean, what do we actually do? So you got a better idea. Obviously, we're going to start at the 30,000-foot level and bring it down. We're not going to get into massive detail today, but we want you to get a core understanding of how that works. And then we're going to talk about the benefits. Why should you work with a national counseling agency? What's in it for you as well as your clients? And then if all of that gets some traction with you, some interest, how would that even get started? What's the steps to take that forward? So I want to have us shift now to some of the things that we're seeing in the market that we know you're seeing, and why we think this is a really good time to consider what we're talking about today. And I'm going to turn it over to Ann for that.
Thanks, John. And I'm going to spend a few minutes talking about the pandemic and how it's affected the auto industry. I know that I'm preaching to the choir because it's your real experience, right? But I thought it would be good for us to take a minute just to level set. So for today's webinar, I reviewed a couple of things. First, my client data, and then I also looked at credit trends from a couple of the national credit reporting agencies. As you know, historical delinquencies rise and fall after as we go into and recover from recessions, and as your lending policies change. And as we all know, auto delinquencies declined after the Great Recession. Beginning though in 2018 and throughout 2019, we saw gradual increase in auto delinquencies, and I know you saw those too. By the end of 2019, delinquent accounts had reached, according to Equifax, delinquent accounts had reached about 1.6% of all auto loans. That excludes leases. And although there's some speculation, a lot of speculation actually, about where delinquencies were going, some said that they were going to increase and some said they were going to stay level. But I think most of the folks that we spoke to in the auto industry were projecting a very slight or no increase through 2020. And then the pandemic, right? So I'm going to talk first about the payment accommodations that are in the lower right-hand corner that occurred after the pandemic started. You know how it affected you, right? You know how many accommodation requests that you've gotten. But for auto lenders overall, the requests for payment accommodations increased to more than 600%. And for most part, you and other auto lenders stepped up to help granted the request for accommodations. So I'm going to jump back up to the point in the upper left corner. And I'm going to talk, I did talk just a second ago about the accommodations, the requests for accommodations. So this point actually talks to those that were granted. According to Equifax, the auto trade lines with payment accommodations increased from well below 1%, in fact, around 0.05% on March the 1st, to over 6.5% as of May the 1st. So in 2.5 months, had that dramatic of an increase. And I know you're not surprised by that, right? And just to level set again on what accommodations are, they're defined as any form of relief that a lender offers to a borrower in times of hardship. And hardship are things like job loss, natural disasters, which we are experiencing right now, job loss as an effect of the natural disaster of the pandemic. It also includes illnesses, military deployments, and things like that. And if you think about it, when payments increase, delinquencies are likely to decrease, and in fact, they did. So if a loan, think about this, if a loan was current when the accommodation was granted, the account would remain current during the accommodation period. So the question is, what happens after that accommodation period? So right now, what we saw in the Equifax data was that severe delinquencies, which Equifax was defining as over 60 days back, down from 1.6% on March the 2nd to 1.4% on May the 11th. So we did see a decrease in delinquencies, and we believe that is an effect of lenders offering payment accommodations as consumers were losing their jobs and having much lower income. So the question is, what happens next? And I know if you're like me, you're reading and looking at what economists are saying, and you have your own economist, right? And they're all over the board, at least what I'm seeing. So some economists project delinquencies are going to go way up. Others are projecting that they're going to stay the same. But one thing is for sure, in my opinion, and that is that when accommodations expire, delinquencies will increase. And that's based on everything I've read and everything that I've seen. But I want to hear from you. So I thought I'd stop and get a poll question and ask for your feedback. So the question is, oh, Marcy, thank you. You already put it up there. What level of 60-day delinquencies are you and your forecasters predicting for the third quarter of this year? And you see the selections, and if you'd go ahead and click now, I'd appreciate your feedback. Marcy, will we see these change, or are you going to show another slide that has the poll responses? Oh, there we go. Let me click off this one box. Okay, so none of you are expecting them to be less than 1%. 29% are expecting it to reach the level that it was earlier this year. between 1 and 1.5%. 14% of you are thinking it'll be between 1.6 and 2, and then the majority are expecting it to be greater than 2. So the problems are real, and they're going to be here. And the question is, how do we help these consumers when the payment accommodations expire? And I thought I'd go to the last point on the slide, which shows that 48% of consumers have more than 2 types of loan products. So when we're thinking about how we help these consumers, it's not only about how do we help them repay their auto loan, but it's also about how do we help them create a realistic financial budget, if you will, so that they can repay their all of their debts, including their auto loans. So I'm gonna go to slide 6. I want to make one final point on here. When we've talked to large banks who have multiple types of loan products, what we learned is that when their customers were asking for loan or payment accommodations, those banks were offering payment accommodations on all of their products with just one call or just one click. So the large banks and financial institutions were taking a holistic approach to payment accommodations. And I say that because it is very relative to the way that MMI and other credit counseling agencies approach the consumer's debt. We take a holistic approach and not just look at one portion of their debt, but we look at all of their debt to help the consumer create this realistic plan. So, I wanted to take a second to talk about our customer, our client. This is MMI's client who reaches out, or a client or a consumer who reaches out to MMI for help. Those clients on average have $20,000 in total unsecured debt, and that's things like credit card debt, retail cards, etc. But in addition to that, 55% of our clients have an auto loan and owe an average of $15,000 on that auto loan. And the payments on those auto loans are about $400 a month. And those clients, over 40% of them, had a delinquency on their auto loan within the 3 months or within 3 months prior to contacting MMI. So I think our clients are your customers. And I think if you look at this profile, you may agree. So, and John talked about this, the types of debts that our clients have. And for us, they fall into 4 categories. One is auto. Of course, we have student loan, credit cards, and then housing, whether it's a mortgage or rent payments, etc. And MMI actually helps clients resolve issues with all 4 of these types of loans. I also want to take a second to summarize, I think, the extraordinary need. I feel like I'm not repeating myself, but I think this is a good summary slide because, for one, it comes directly from the AFSPA Daily Connect email that was sent out just a week ago today. And so it is very relevant to you and to your customers. Consumers have requested hardship help on 15 million credit card accounts and on 3 million auto loans. This pandemic has caused the sharpest increase in unemployment rate ever. A week ago, it was 38.9 million unemployment filings, and then today I saw it's topped 40 million. Most of these claims occurred during March, April, and May. And thankfully, many of the consumers who are requesting unemployment help are getting it. Not only are they getting it from the states in which they reside, but they're also getting the federal unemployment help. And that's helped to keep them stable, or many of them stable for right now. But we know that unemployment benefits are going to expire sooner, later, we're not sure, but I'm thinking a little later than your payment accommodations. So we know that there is a light at the end of this pandemic tunnel that we're in. And unfortunately for me, that light doesn't seem like a sunbeam. It seems like a train that's getting ready to hit many of these consumers who've been impacted. I think I'm going to stop there, and I'm going to turn it back to John, who's going to give you an idea of some of the things that we can do to help you with your customers who are going to be affected. So John, back to you. We can't hear you, John.
Thank you for that. Sorry, I was on mute. Thanks for your paying attention, and we're going to kind of go now from maybe what I'd call the 30,000 foot level down to 10,000 feet and try to get you a little more in tune with what we do and why we think it's got so much value for your clients. I mentioned the background that Ann and I had pre-counseling, and I know one of the things that you probably have all had drilled in your head, as I did in all of my lending and leasing roles, was that lending to people, extending credit is a combination of their willingness and ability to repay you. And those are the things that you're trying to gauge, willingness sometimes being the harder one, unless you've got experience, and ability being the financial analysis that we do. One of the big things that's clearly happening right now, amply demonstrated in the statistics Ann just went through, is the impact of people's ability. It may not have impacted their willingness at all. They're good folks. They've paid you regularly. They want to pay you regularly. They don't know how right now. They may not have a how right now. The government is helping them in the interim, and that's helping everything. But there, as Ann mentioned, are challenges to come as we start to taper off those benefits. And when we talk to people in our regular counseling, there's a couple of things in broad scale that bring them to us because of problems. One could be behaviors, and that's a classic story you might hear of somebody who's just spent more than they had, and they've been treading water just above their debts, and then the water gets above their nose, they can't breathe anymore, and they call us, and we kind of point out, your social budget or something else is a bit more. But the other is situational, and situational always happens. The situation could be someone gets divorced. It often is a health issue. It could be an unexpected job loss. And clearly, today, the people we're going to see are going to be situational. And so a lot of these people that we are going to deal with, that you're going to deal with, are people who historically have had a strong willingness and the ability to pay, and they haven't found themselves in this situation. So now they're in a brand new situation. And it's not a comfortable or a familiar situation to them. And that creates a huge amount of stress to them, because they're trying to make decisions on things that they're not that familiar with. So when someone comes over to us through their creditor, or however they get connected to us through the internet, like many people do these days, the first thing that we want to do is start to mitigate that despair that they might have of their situation, because they're just dealing with too many what ifs right now without answers to put behind those what ifs. And that's what we're going to try to help them do, is first, let's get that despair out of the way and start talking to you about the things that are out there, that your creditors have out there, that you should be aware of, that the government has out there, that you might have heard of, but you might not even be fully implementing. Then when we start to establish that comfort, that trust with us, we start to get into their real situation and what's happened. What does their budget look like? What's their employment situation look like these days? Or whatever are the issues driving their personal crisis. And you might have heard, as we all have, that there's all, as Ann talked about, there's all kinds of forbearance programs going on in all of those different lending criteria, those categories that we shared with you. But there's some challenges in getting those implemented. I'll just give you one example, right? So student loans are being automatically deferred for folks. But if you're really tight on cash flow because you're out of work or you're a restaurant worker, and even if you can work, your income is dramatically dropped. If you've had things on auto pay, that auto pay will probably go through. And when you've got $1.5 trillion in student loans, to try to go back and say, wow, I accidentally sent in my $500 student loan that I don't need to, that's a lot of work, as you can all understand. It's going to take time. So one of the things that we do with people is help them, like on student loans, understand, well, do you have a private loan or do you have a federal loan? Because they're different. Do you have auto pay, right? And lots of other things like that. In each of those categories, I'm not going to belabor each of those categories, but each of them has nuances that a lot of people will struggle to fully understand and create a plan from that. From that process, from that exploration, and that teeing up for them of some of the solutions that they could take advantage of, what we're trying to do is free up cash flow for the things that are more fixed for them. And it might be your auto loan, as an example. It might be that we don't have to touch your auto loan. We're not going to touch your auto loan, but we're going to help the rest of that budget. And that makes everything else easier. And as Ann said, right now, I assume most of you have some kind of a deferral program in place, but at some point those have to come back to repayment, whether you're accruing interest or not, whatever your policy is. At some point, those folks who may or may not be back into a employed situation are going to have to face those obligations again. So from that, we're creating a solution, right? And the solution for us, when we bring in, as Ann said, holistically, that's the term common in credit counseling, meaning we're looking at their whole situation. When we bring in those major debt obligations that they have in a holistic plan, we're looking beyond the deferrals. We're looking beyond this month. We're trying to keep them from ping-ponging back and forth between which debt, which collector got to them first while they maybe still had money, and that person wins that month, to something where everybody gets long-term success, which I know is what everybody wants. Everybody wants to lend money responsibly and to be repaid as planned. That's the business that we're in when we're in the lending business. And as we mentioned, we're trying to build sustainable affordability, something that works, not just today, but works for as far as we could see. So the next slide here that I've just put up is kind of a summary of that. It's restating it a little bit, but it's really, you have that client that comes to you in that left-hand column, and everything's topsy-turvy. They're in an unmanageable financial situation, and they maybe don't know where to go. And you think about it, a lot of people get out of college. They don't have one student loan with one lender. They have 4, 5, 6 student loans with a mix of lenders and a whole lot of different options depending on the types of things, plus what's their personal situation, right? Do they work for a nonprofit where they get some relief after 10 years? What about income-based repayment? There's a lot of programs there that folks aren't going to be expertise on. They might have more than one vehicle loan. They might have 5 or 6 credit cards. That's a lot of phone calls to make to try to come up with a plan and then go back and pitch that plan to everybody. So we're going to take that. We're going to go through that center column of counseling. We're going to talk about in a minute a debt management plan. It's a very common program that we use for folks who have too much credit card debt because it's an easy thing for people to accumulate. What's the situation with their housing? And is there relief whether they're a renter, whether they're a mortgage borrower, or something else? What is out there that they can take advantage of, even again, if it's temporary, because we're going to start looking at what do we do when the temporary ends, but there's both temporary and then longer term. Same thing with student loans. Obviously, budget tweaks. Not everybody sits down, as I'm sure many of us would raise our hand and say, no, I don't really sit down and do a great job on budgeting, but we're going to create an actual budget with them that we're going to share with them. And for some folks, it might be the first time ever or the first time in a long time that they've sat down and really looked at things, and maybe we can find some places there where they recognize, yeah, I can cut back on some of that to get me through this crisis. And then again, obviously within that mix, and very pertinent to today, is what's their current auto loan and how do we help them to keep that going forward. So I mentioned a debt management plan, or what we call a DMP, and it's an example of the kinds of solutions that we can bring to the forefront. Now, again, there are all kinds of programs on housing, and we're very involved with Fannie Mae and some of the other major lender, government, quasi-government lenders that you're familiar with. Lots of student loan things, lots of other things there. We're going to talk about one example here that we deal with quite frequently, and that's helping folks who have just accrued too much credit card or unsecured personal loan balances. So when you have had problems and you've missed some payments, or you've paid late too frequently, you've done other things, your original contracted rate on a credit card may have gone up to something like a default rate or just a higher rate because your behaviors are saying you might be becoming a higher risk. And that's how that works. You might be missing payments and accruing fees and other things. So what we're going to do on that is create a budget for them. We look at that budget, and then we look at programs, concessions that creditors have told us, we'll do this for people if that will take them from unable to pay us to able to pay us. And it's not eliminating principal. It's really saying, well, we first and foremost for all of us, if we're lenders, is to get our principal back. We want our interest. We want some of our other related costs, but we definitely want to cover and retain our getting our principal back. So we will put together that whole budget for that consumer, and then we propose it to the creditors. And the important part there is because there are a lot of different things out in the market you might be aware of in terms of how people do credit repair or do debt settlement things. One of our key things is collaborating with creditors, and we do that because then when everyone's on board, it really reduces the stress, as we mentioned there at the bottom. So we, because we work with them all the time, have become familiar with what programs and policies creditors are willing to use to offer concessions and what they're looking for in terms of the consumer characteristics that would justify that. And so we have what I would just call a high strike rate of what we propose gets accepted. And so that whole piece goes into the creditor, and we get their proposal back, and most people pay us on an electronic basis because that set it and forget it works very well for their success, and the stability of that gives them a foundation to start rebuilding around. Okay, so how do we get that help to your customer if you're seeing something there and thinking, yeah, we're hearing from our collectors that people are telling them they had all kinds of problems. It's not just your auto loan. I'm trying to juggle all these things. Well, the way it works with the creditors that we work with, who we showed in that earlier slide, is most of them connect to us through a dedicated phone number or a dedicated URL landing page for a web connection. And many of those creditors will use a warm transfer, again, to create a real comfort in the consumer's mind that this is someone we're taking you to that we have confidence in, and that the consumer knows that they're getting to a good source, not a scam source, because the scammers always come out of the woodwork in these times in large fold, as you know. Our counselors then are going to spend somewhere between 40 and 60 minutes with them, understanding their situation, creating that budget, and the action plan that we've talked about. Now, of note is that our counselors do not have any constraints on how long they talk to a customer. So whatever the emotional state is of that customer, we first are going to hear them, understand where they're at, and try to get them in a good state of mind, because you can't really learn. It's not really great for decision making if you're under extreme stress. And so we're going to try to get them there, and then tell them, based on everything you've shared with us and the budget we've created, here's our recommendations. We're doing that, as I mentioned earlier, by applying existing creditor solutions that creditors have said, we will grant these when proposed for customers that are really struggling. And so we go through that whole thing. And then when we get their approval back, and again, that's all done electronically. It's sent out every day. We get the response often that overnight or the next day or within a couple of days. So it's a very automated process. And then going back to that first point on the slide, because they have come in on a dedicated line or a dedicated URL, we know that, for instance, that client came over from XYZ lender, and we're able to create reporting. And what would that reporting say? Well, that reporting could say, for instance, yesterday you sent over 50 clients. 47 of them went into a counseling session. 3 of them, when they kind of got off the phone with you, said, I don't really want to do this right now, right? That's normal behavior. We see that. And then how many finished? And then what were the recommendations we gave to them? Eventually, how many of them took up those recommendations? Because there's some self-discipline you've got to do here, right? We're going to start to cut down on what they can do with credit cards. You can't keep charging if you're getting concessions and so forth. So then how many of them take up that plan? And then what's their success in that plan? And we can provide you with all that reporting. Even if for instance, because we're talking to you auto lenders, what you're really seeing, and not even maybe part of the plan, because your payment can just keep coming to you, but you could get information on how folks are performing that you sent to us. And just to mention, because data security is so important anymore, we're going to share with you as much information as we responsibly can, but we are extremely sensitive to PII type information, private health information, all of those things. We are very overboard, if nothing else, on compliance because the relationships we're in require that, and we require it of ourselves. So we're going to give you as much reporting as we can. In some cases, it has to be consolidated reporting. Some cases, because it's your client and you already have access to their credit profile, it can be individual. And that's just something we work out with every organization we work with. So I want to talk a little bit about the benefit. And one of the things I want to talk about that I think is important to remember, because we talked about some of the deferrals and the other programs that are out there. But an interesting statistic that's often quoted is that during the height of the Great Recession, which was really driven by housing challenges, 50% of the people who had their home foreclosed never called their lender to talk about the challenges they were facing, to try to work things out. Now, this is a little bit speculative, but my belief on why that happens, and I think it is more impactful when you're a secured lender, is because people aren't sure what is going to happen and what that might kick in. And so if I have a home and I know this isn't going to last for long, I just probably made my last payment, I don't know how many months I have, but I also saw in the news somebody with all their possessions out on the sidewalk and the sheriff there. I don't want that. I've got kids. And so they are trying to figure this out without getting the full information. And as lenders in the Great Recession, people didn't want houses back. There was no market for it. And I know that in this market, where we're going to see a significant oversupply in the used car market, people are not going to want those cars back if there is a better solution to keep the payments coming. So what's important on that point is that folks do seem to have a higher trust level to talk to a nonprofit and to share their challenges. And then we can convey the solutions that creditors are really putting out there, but turn those solutions, as I've mentioned, into a unified plan that reflects that consumer situation and the opportunities that their mix of different creditors have brought to them. So one of the things I think that can be really good for you, and I don't know who's on the phone out there, so I don't know if you're large national lenders, you're with a name brand lender of an auto brand, or you're with a regional. But brand is important because customers can be expensive to get. Repeat customers can be a wonderful thing. And by demonstrating to them that the first thing we want to do is to get you help, I can't see how that can hurt you. I think it can only help you that the first thing you did was reached out a hand of help to them. And that's the tone and the approach that they're going to feel when they talk to us. The second point is, there's just no question that right now, the aggressive organizations that will come after people and promise them miracle solutions without maybe fully disclosing the longer term impact of those solutions, if they are miracles, and they aren't, and if they are as presented, they're preparing. There's no question they're preparing, and there's no point in being out there right now, because deferrals is the action of this period for 2 to 3 or longer months. But you can expect to see an awful lot of advertising telling people, call us, we are going to make your day better by having you not have to pay much of this back. And so by being proactive and getting to somebody else who can, again, help that confused consumer get onto a plan, I think you really help yourself, and really you help them. And again, we're talking about win-win solutions here. What's really important when we talk to folks like yourselves that are secured lenders is that you understand we are additive to what you're doing. We're not going to impact your existing client collection efforts. Now, if a client's paying on time, you don't really have to do much, right? And that's where we want to get into. That's why in these collaborative approaches, creditors like it, because once somebody goes on to, for example, a debt management plan or something else, and that consumer performs, you don't really need to collect. The payments are coming in. We don't do anything to restrict you from talking to your client ever, because again, this is intended to be and is a collaborative effort. It's also important that you understand you always retain your right to recover your collateral. And so we never get in the way of that. But we believe that with the increasing use of early predictive tools, you're able to see people that are heading towards trouble well before you would be at that point where you're actually going to go out and, for instance, do repossession. Now, the market's moving incredibly quick right now, so those timelines are all tightened from normal behaviors where you see percentage of available credit being used, or you start to see recurring late payments and things. It's kind of hitting like a tsunami right now. But nonetheless, you've got time to look at these situations and get people help. And in this market, and this is where, again, I wish we were sitting in a room so I could see your faces and your heads nodding or shaking and telling me, John, you're right or you're wrong, and educating me. But from everything I read, it's going to be a tough market because there's going to be an excess number of cars, which means values are going to face downward pressure, which means you're going to face a tougher time in covering your balance, and then you're dealing with a higher delinquency balance to try to go get, which, as best as I can see it, is largely then an unsecured type of obligation that you're trying to recover. So hopefully, through something like this, you can find ways to mitigate at least the number. It's never going to be a cure for every case, but at least the number of those situations that you deal with. And again, one of the key things for us is extensive reporting so you can learn, adapt, improve. And the reason that's important is because you start something that's new and you've got several parts of this. You've got the talking points that your folks are having with people, and they're talking about, well, maybe there's something else you could consider that would help you with your situation, right? And so we look to do that. We talk about that as an engaged relationship. These programs can be as easy as you want them to be, and they can be as engaged as you want. So with some of our cars, we meet every month. We review statistics. Every quarter or so, we listen to a redacted call, so you don't know who it is, but you hear the experience. So everybody learns, gives feedback, and we just work to get better and better, and we see that improvement over time. So I think, again, I mentioned this earlier, one of the things this can do is help support your teams in areas that you may not want them to cover. And we're going to poll the audience again here. Marcy, if you can bring up that next poll that we have, and we'll throw that one out there. Wonderful. So the question here is, we've talked about all these other debt obligations. We just want to validate our thinking since we're not in the same room. And what do you tell your folks when they say, wow, people are dealing with all kinds of problems? Do you support them discussing any of those non-financial issues? And I appreciate, we'll just give it a minute here like we did last time. If you'd pick one of those that seems closest to where you're at, and we'll look at the results here in a minute. Thank you. Great. Okay, well, that's honestly, I am surprised because 80% of you said yes and sometimes, and that's something I would love to explore with you, but we're not going to be able to do it today unless you throw some comments in, which we again welcome very much. And I relate that to, like in our case, we do not let our folks, even if they think they're master investors, venture anywhere into talking to people about their investments. So if somebody said, well, I've got a lot in my retirement fund, what do you think I should do with that? We don't have people go there because we haven't trained them. If we don't have controls and we know that we're within compliance, we steer clear of that. But I'm glad to hear that you're doing that. And hopefully we could be, a part of that for you if it's of interest. So I want to go to the next slide here, because people might be thinking, hopefully somebody's thinking, well, this is kind of interesting. What's involved? Not really much involved to get going. I mean, we can do as much as you want in training and lots of things, but the biggest thing to get accomplished is we set up dedicated phone lines or URLs with landing pages, and we can do that landing page depending on how much you might want to customize, or you just want it to come to ours. We can do a lot of that stuff in 2 to 3 days, and you can be up and running. It can be as simple as having a phone number with your folks' desk, or we can get way more involved with folks who want to put a lot more sophistication in what they do to assess when they might send clients over us for counseling. There's no cost to do this. All the counseling that we do for folks is free. Some programs that we get into, and they vary a lot. Some programs have government funding behind them, like a lot of housing counseling has government funding behind them. And there are some client fees if they get into longer term plans, and there's some other things that people fund us to do for them when they ask us. But basically that initial counseling session, the action plan, all is done for free. And you might be wondering, well, is this really successful? So we use the DMP as an example here, the debt management plan. So I'm going to go back to that for a minute. The folks that we put into a debt management plan, which are limited to 60 months by the Office of the Comptroller of Currency that oversees most of the banks, most of the national banks, has limited debt management plans to 60 months. So we're putting folks into a plan to repay all of their credit card and unsecured debts in 60 months while staying current with their other obligations in life. And 80% of the people that MMI puts into one of those plans successfully completes that, meaning they get all of their credit paid back through us, or sometimes when they have a few months left, they call us and say, I'm there, I'm good, I have one creditor left, and I'm ready to be on my own, and we wish them well. And so we believe that we can really help people because, again, that holistic plan, that budget is designed for this kind of success. It's not coincidental. And that is really the gist of our presentation today. And we're going to go into Q&A now. We've got, right on time, actually. So we've got about 15 minutes here for any questions anyone wants to pose. And I'm going to turn it over for Marcy, who will facilitate that part of the call.
Thank you, John and Ann. We have a few questions. The first one is, how long does it take to get someone help when they know they are struggling with many debts?
Oh, okay, great. I can take that one. Sure. So MMI is 24/7. We're open basically every hour of every day, except for 3 holidays of the year that we let our folks have time off. We target to answer calls within 30 seconds. We really try to discipline ourselves. And again, to have the kind of call center performance that you would expect in any professional call center. We have online requests that people can make to be called back, and it would depend on the time of day that they reach us. And we continue to build out our chat tools and other things. We're doing a lot of work in artificial intelligence to create even greater interfaces with folks, because we know that's the preference of a lot of younger folks, is to have a very dynamic online tool. Thanks.
Thank you, John. Another question is, are there any keys to working together successfully?
Great, thank you. So I think I mentioned engagement. I think that's the key. Make the program as much as you want it to be, and the level of involvement that you can dedicate. And so it can be as simple as some of our cards do. If they have a line set up, and we meet periodically and review things. And as engaged as we mentioned with some folks, we share a lot of reporting back and forth. They also provide reporting back to us. They give us feedback on how we perform against other counseling agencies that we work with, because there are a number of counseling agencies, including a few other large national ones. So we learn from the data on that. And then I think the last piece, if you want a program like this, is what I will broadly call associate motivation. And that's, are they getting acknowledged for using the program, and obviously compensation, right? These programs will crater if, in fact, a person who is in I'll just call it a collector role says, well, I wouldn't do that unless basically it was the last moment I would ever deal with that customer, because there's no point in me doing that, right? So you have to have just equity as it reflects for you as an organization. You'll benefit from this, and you would want them to benefit similarly, even though we do some of the work.
Thank you. Another question is, what happens if someone has more challenges while on a plan?
Sure. So we're not able to make people wealthy through what we do. We're making them manageable. We're making their situation manageable. So we get them from, I described it earlier, as to they feel like their head's below water till we get their head above water. But still, they're going to run on a tight budget, as actually a lot of people do in normal times. So when they hit a bump in the road, which is almost inevitable, whether it's a health issue, whether it could be a car cost or something that comes up, a repair cost, any of those things that could be a few $100s, and we see the statistics about how many people can't afford a $400 or $500 incident. Well, we've got support teams, and those support teams are going to look at where they're at and talk to them about what's the challenge, is it a short window? Can we see what's coming, or are you taking some other steps? Sometimes people say, yeah, I just, I've got some medical costs, but I also got a part-time job. And then we figure out, how do we get connected with their creditors and get people to understand where we're at and how this fits in with their policies for when they allow people to, defer partially or whatever, and build that into a plan to get them through that period. Thanks.
Thank you. Another question is, does a consumer have to join a plan to get budget assistance?
No, they do not. Again, all of that front-end counseling that we do is done for free. Every customer will get from us their budget that we create. They will get an action plan. It will have suggestions that were talked about in that call, and those suggestions could be anything from, we give them some references to social service agencies or even apps that help people better manage their money, or get food, for instance. They're unemployed and I just got unemployed, I'm in a panic, I don't even know how I'm going to eat. And well, we've got reference information on their local food banks and things like that. So we go through all of those things. Most people receive that whole action plan as an email, so they're going to get it within an hour or so of when they hang up. So it's very timely, and both in their minds, and they can relate to it. And the same thing we do if they said, I'm actually interested in going onto the plan, the debt management plan, as the example we shared in this. So we move quite quickly with that.
Great. Thank you so much, Ann and John, for sharing your expertise with us. Remember, the slides and recording of today's webinar will be available on APSA's website under the Webinar Resource Center. Thank you very much, everyone. This concludes today's webinar.
Thanks all.